Order blocks have become a very popular concept in trading recently. And here at Defibers, we do have a few traders who use order blocks in highly effective ways. And in today's video, you will hear from one of them, Victor, a funded trader here at the firm. He will break down his approach to trading with order blocks and show you how this concept can help you improve your own trading strategies. Let's jump right in.
I will be talking about order blocks, of course, for everyone who hasn't seen me before. That is one of the concepts that I use all the time, every day, in almost every moment I trade. But before I do so, my name is Victor, if you haven't noticed already. And the reason that I have a mask is that I get to call myself the mask trader. So today I'm going to be talking about a concept which is, I think, fundamental for technical analysis. It's the core. It is something that can help you read the market better, and that's why I think it's so important, right? So reading price action through order blocks. But before we do so, let's start with the obvious question. What is an order block? What are we talking about when we talk about order block? What is it, right? And if you look on the internet, you get different variation for the definition of an order block. One of the first one that most people would have read, this is from Baby Pips, saying order blocks refer to a specific price area or price areas where large market participants, such as institutional traders, have previously placed significant buy or sell orders. That's a good definition. I agree with it. Although it says, right in the definition, it says buy and sell orders. It doesn't tell us, are these market orders? Are these limit orders? And how do we know where large market participants or institutional traders have placed their orders, right? Since the Forex market is a decentralized market. So I have a little bit of issue with this definition, but it is a very solid one. We find another one. It says order blocks are areas where there is an outstanding amount of limit orders. This definition is a bit more specific. Limit orders, right? Causing large reaction in the market when price reaches these areas, right? So this is talking a bit more about the reaction. I like this definition as well. And lastly, this is from a very popular figure in the Forex market nowadays. I won't mention his name. This definition is the order block is the zone area in a price chart where a large number of orders are executed by institutional traders in the market, and markets show sudden strong move from that area, right? So all these definitions are very, very similar, but there are differences in them. And the thing is, I think that trading needs to be as objective as possible. And when there are more things that you need to check that depends on your interpretation, right? For example, in this definition, it says sudden strong move. What is a sudden strong move, right? I start asking myself, what is sudden? How do I define sudden in this case, in this context? Or large number of orders. How large? When I want to use something, if I'm going to be using something for my trading, I want to be as certain as possible that I'm identifying the right structure or concept phenomenon in the market. And if it depends on my interpretation, you might not be as precise in the identification of that structure. So although I agree with these, I like to use my own definition, which is much simpler for an order block, right? And to me, an order block is simply either an engulfing candlestick pattern or an outside bar. Very, very simple, right? Next you can see what an engulfing is, and I will talk about it, of course, what it is, how to identify it. But this is as simple as it gets. And in trading, it's important I believe it's very important to keep things simple. Since I defined the order block, differently. And with a candlestick pattern, the engulfing or the outside bar, for those of us who we're starting in trading, it's important to understand basic anatomy. Although Abe did already start touching and explain very beautifully on this concept, I would like to review a little bit, just in one slide, what are we talking about when we say candlestick, right? Japanese candlestick. So candlesticks, Japanese candlesticks, are a graphical or visual representation of, in this case, price, the movement of price through time. Okay, so each candle represents a specific period, time, and this candlestick represents or depicts that movement that it had in time, right? And it has a different parts, right? You have the body, of course, which is the wider part of the candlestick, and you have the lines on top and below what we just identified as the body, and these are the wicks or the shadows, right? You have the upper wick and you have the lower wick or shadow, and together they form the candle. Importantly, and later you will understand why I'm focusing on why it is important. Also, the candle is formed on 4 data points, right? These data points are not open for interpretation, right? They are hard, objective numbers that we get each time a candle closes, right? The 4 data points are, of course, the open. And in this case, because it's a bearish candle, price moved from the open and closed lower, it means that it's going to be at the top of the body. At some point during the period that the candle represents, a price may reached a highest point, right? Which is the top of the wick, which is the second data point, which is the high of the candle. And similarly, during that period, price also reached the low of the lowest point, which would be represented by the tip or the extreme of the lower wick. And finally, you have the close of the candle, right? So there you have, these are the 4 data points of each, by which each candle is formed, right? So you have the open, the high, the low, and the close. For a bullish candle, it's similar, it's the same. You have the open, but since a bullish candle, right, is opening and closing at a higher price, the open, of course, is going to be at the beginning or the bottom of the body of the candle. Okay, and the rest is similar. You have the low of the wick would be of the lower wick would be the low of the candle. The extreme, the highest point of the upper wick, of course, is the high of the candle, and you have the close, which is where price ended at the period it represents, right? So if you understand this, which is of course very basic, but of course we are here helping all kinds of different experience level of traders, newcomers as well. So this is important, guys, for new traders to understand this concept, right? These how the candlestick is formed. Now that we know the definition that I used, which is personal, of course, and the data points, I would like to define what an engulfing is, right? It is the body, right, of a candle, of course. Body needs to be in the opposite direction, and it needs to be bigger than the previous candle, right? The previous body, okay? That's the definition of the engulfing. And the outside bar is the range of a candle must exceed both the high and the low of the previous candle and close outside the range of that previous candle. And I'll have a couple of examples. Here we can see the bullish engulfing, right? Where we have the body of the first candle, where we have it here, not the first candle, but I mean the last candle here, the body is bigger than the body of the previous candle, and it is in the opposite direction, right? This would be a bullish engulfing, of course. And we have another example of a bearish engulfing, where you have the body being engulfing, that's why the name is engulfing, candlestick pattern, being bigger than the previous bar, and by doing so engulfing the previous bar as well, and it needs to be in the opposite direction, right? That's for the bearish engulfings, right? The other one are the outside bars, and here you can see clearly that the green bar not only is bigger, the body is bigger, but also that it took out the low of the previous candle, right? Remember the definition, it needs to take the low and the high, so take the whole range. That's why it's called outside bars, because it trades outside the range of the previous bar, right? So it takes out the low, it takes out the high as well, plus it closes outside of the range of that previous candle, right? This will be a bullish outside bar, right? Outside bars, by the way, are stronger, are basically, they are engulfings on steroids, as I frequently say, because they are stronger than regular engulfings, right? And the other one is another example of a bearish outside bar, where you have the same thing, just in the opposite direction. The red candle takes out both the high and the low of the previous candle, plus and closes beyond or outside of that range of the previous candle, right? That would be a bearish outside bar. Now you may ask yourself, but hey, Victor, why do I use outside bars as well as engulfing? Because look at these candlesticks where you see the bullish outside bar is also an engulfing. Why I don't use just an engulfing and not an extra definition as in outside bars? Well, the reason that I specifically use outside bars as well, and I define them, I look for them consciously besides just engulfing, is for the following: because not all outside bars have opposite direction in the candlestick. This, for example, is also a bullish outside bar, right? So because if you look at the definition of the outside bar I just gave you, it takes out the low of the first candle and the high of that candle, that previous candle, and it closes above it. However, if you look at only the bodies, it is not in the opposite direction. However, so this is a bullish outside bar as well. However, the effect or the phenomenon or the psychology of the market participants as these two bars are formed are the same. So this is equally powerful as when it has a different or opposing direction of the candles, right? Bearish, bullish, and this one is bullish, bullish, but they have the same kind of effect on market participants, right? They went through the same process. And of course, you can have the same candlestick pattern where you have both bodies being in the same direction, but still forming an outside bar. And these I also consider order blocks, right? This would be the bearish outside bar, where it takes out the high of the previous candle and the low and closes beyond or outside that previous candle, right? So these are the order blocks to be. And I understand that, it is different than other people definition, but this is making it simple is very, very powerful. So it is important that we appreciate the fact that it will allow you to very quickly, without a doubt, identify what an order block when you have such an objective and simple definition for that order block. Well, why are order blocks important? Well, order blocks, they indicate swing points in the market, right? Reversals, you could call them, right? Where price change direction. One side, either the buyers or sellers, depending on what kind of order block it is, a bullish order block or a bearish order block, one side took control. And why is this important? It is important because not only it tells you that it's telling you something that happened in the past where one side took control, but more importantly, it tells you where whoever took control, they are likely to buy or sell again, right? If the buyers to control, the buyers are likely to buy again at that area, right? Depicted or indicated by an order block. That is why it's important, because it gives you a hint of what is going to happen in the future, right? And that is edge, my friend. So that is the importance of the order block. And the next thing is, how do you mark the order block, right? For the bullish order blocks, the area that I mark is the area that extends from the body, right, of the previous bar to the lowest wick, which is, in this case, you can see the body of the previous bar. This is a bullish order block, right? Price went down first and then ended up bought up with buyers taking over, right? Taking control, what I just mentioned. And the area, it is the area from the body, right? It needs to include the body of the previous candle and includes the lowest low of those two candles. If it's the first candle is the lowest low, then that's going to be the lower border of the order block. If it is the second, then it's going to be the second, whichever is the lowest, okay? And the bearish order block, the area that is considered order block to me, is including the body of the first candle and the highest point, right? In this case, it's the second bar that has the highest point. That's the area that I consider the order block. There are variation. There are people out there who include the whole candle, right? The whole range, including the wicks of the first bar, to be considered as an order block. And that's fine. I prefer to make this area as tight as possible because it lets me be more selective, right? So it's not wrong, and you will hear this more commonly. People use the whole candle. It's okay as long as you keep on doing the same thing, because that is what will bring you consistency. Personally, I prefer to use only the body and not the wick, in this case, the upper wick, for a bullish order block. Of course, the lower wick always is part of the area, right? Because that's the extreme price went before it changed direction. All right, so that's how I mark the order blocks. Now, how to use them, right? How can you use that information for your trading? How can you profit from this? How can it make money for you? What can you do with an order block, right? Well, when you think about it, essentially order blocks are areas of supply and demand where price went, let's say a supply area, price went up and price sold off from that area, creating that supply area, letting us know that at that point there were more sellers than buyers. Right. And when it does that, a lot of the times, not always, a lot of the times, it will leave clear order blocks behind, indicating the points where the sellers to control in the case of the supply area. So basically, order blocks are another form of supply and demand, which is a variation of support and resistance, right? Typically, supply and demands are areas, support and resistance are a bit more lines, although there are also areas, right? So this is the basic understanding that order blocks are just a way to read the market. Where are the sellers interested in selling and are likely to sell them price again when it comes to that area. And the same goes for the demand area, where buyers are willing and able to buy, whether they are resting limit orders there, pending orders or not. Fact is, by the fact that the order block was formed already gives you an added probability, right, that the market will react and buyers will come in at that demand area formed by the order blocks. So how do you use them? Order blocks can be traded when they are retested. The same thing, the same concept that Jonathan just explained, where price comes back to a break and retest, right? It makes a breakout, comes back, and gives you that opportunity to buy and get in with the continuation. That's the same thing, same concept that can be order blocks, and that is how I trade every day. That's how I got funded. Very simple, right? It is at the retest of those order blocks, right? Price forms an order block and then comes back to retest them before it continues. In this chart, you can see this is a recent EU price. This is the daily time frame. You can see how the order block was formed. There are many order blocks all over the place, but I'm identifying the one that actually were at important swing points, right? It was formed here. The order block was formed, price moved away from it, and then as it came back in to retest that order block, changes direction. The sellers formed the order block to begin with. They came back to the market and were willing and able to sell the market, defending that structure that they created and pushing prices much lower. The same way, you can see how the order block that was formed by the buyers at this specific swing point, as price comes back in, they are willing and able to buy it again. Not all order blocks work. Of course, price will break them from time to time, right? It is the trick, of course, is knowing which order block to be using, but at least by knowing that there is a structure here, you already have an advantage on other traders, because you have something that puts the odds a little bit in your favor, knowing that buyers, they will be buyers here because they bought this price in the past, and they're going to be buying it again when price come back. Whether it's going to be enough to make a complete reversal or just a pop, that's another thing. But as you can see, these areas created by the order blocks are basically some supply and demand areas. Basic way to use order blocks, right? When price comes back to retest them, and the same way that Jonathan explained, the number of retests makes a difference. The first retest being the strongest reaction you're gonna get is from the first retest. The second and the third can still be traded. However, the more retest happens, the weaker the structure becomes, right? So personally, I only trade the first retest, but the second is still profitable, and even the third is quite nicely able to be traded. So the first way to use it is for the retest. However, you can use order blocks since they are basic expression of supply and demand. You can also use them to protect your position, right? To put your stop loss, helping you putting your stop loss in the case of a buy order, right? And you have a bullish order block below you. You want to be putting your stop loss below that structure, right? So because you know that buyers will come in and defend that position, so the best way is to put it below that structure in the case of a buy order and a bullish structure. You can also use them as targets, right? Since you know that price will react to them, it's best you get the trade off the table before it reaches that structure, because that may be a structure that might reverse price, right? Since let's say you're in the same buy order or buy position, and you have a bearish order block ahead of you, right? It's best you put your take profit before that structure, because it will make sure that the structure doesn't reverse price before reaching your target. So you can use them for stop placement as well as take profit placement, but you can also use them as confirmation signal. Imagine you have a setup, a strategy that is not based on order blocks, that is completely different. And when price comes to that area that you were waiting for price to come to, you need to get a signal that confirms that the setup is going to work, that it's activated, and you need to get into the trade. Well, order blocks can be used for this, because remember what I said, order blocks are a representation of a swing points in the market, right? When market switches back as it comes to your area to go in the desired direction. So you can use them as confirmation signal to get into your trade as well. And that could be in a different time frame, not necessarily on the time frame of the setup, but it can be as well. And lastly, you can use order blocks as a component, as a tool, right? Another tool in your toolbox, or as Jonathan already mentioned, as a confluence to already an existing strategy that is perhaps not based on order block, but you can use this to increase the probabilities of the setups, right? So order blocks can be very versatile, as you can see, in how to use them, when to use them for your trading, right? And the last thing I want to say about order blocks is that besides what we just mentioned, right? The retest and using it for stop loss, placement, etc., or as an add-on to your strategy, your already existing strategy, because the order block is where the buyers and the sellers come in, right? If you conceptualize that for a little bit, if you think about it, if I know, okay, buyers came in at certain points, if I take an overview, a bird's eye view of the market, zoom out a little bit, the frequency of order blocks tells us something, right? If buyers are coming in more often, that's a bullish sign, right? So the creation and the invalidation of order blocks, they help you understand the narrative of the market, right? In simple words, you can read price action through the creation and invalidation of order blocks. And invalidation, I didn't explain what that is, but that is when the order block is broken, meaning when price that's my definition, when price in a bullish order block, when price closes below that area that I depicted, right? In a bearish order block is invalidated when price closes above the area of the order block, right? So by reading the frequency and the degree that market is creating and invalidating order blocks, we get a glimpse, right? A tool, a way to read the market, answer the question, the main question when you are trading, which is who is in control, right? Is it the buyers who are in control or the sellers? This is very important, almost as important as knowing market structure. Market structure is the basis, but this is the next best thing, right? After market structure, you want to be reading who is in control. Normally, the market structure is already indicating who is in control, right? But order blocks is another layer to help you cement your confidence in knowing who is in control, right? And this is gold, weekly time frame of gold. This is recent price action. And you can see how a order block, right? This is a bearish order block and a bullish order block. And you can see there, when we have both bearish and bullish equally frequent being created, you're likely to be in a range. Not always, but you're likely to be in a range, right? Because the fact that they're creating these order blocks in opposing direction tells you that they are roughly equally strong in this area, right? And you can see how we had two bearish order blocks and two bullish order blocks being created, right? Further emphasizing the fact that both sides, they have a chance of beating each other, right? They are strong and they're showing their strength by forming those order blocks. However, at a certain moment, price breaks this range, right? We can see that in the following price action, that the market breaks out of that range. And before it did so, it gave us indications, right? When we had two bearish order blocks and two bullish ones, it wasn't clear based on the number of order blocks which side is going to win and which direction price is going to go. However, before it actually leaves the range, it already started, as you can see here, building up order blocks, creating order blocks before leaving the structure, right? That is an indication who is gaining control. That is reading price action before it actually breaks out, right? And you can see how it forms an order block and another one on top of that, these two order blocks before it actually breaks out. And then you have this big candle, huge candle, which if you were reading price action, you would have been able to position yourself and enter in this direction because you already saw that the market was gaining momentum to the upside. So it's telling you you're by reading the creation, right, of the order blocks, you can get a glimpse of what's going to happen, what the intention is of the market. Not always it's going to go in that direction, but if it's going to go in the direction, it is likely to be leaving order blocks behind because that's how the market moves, right? And then it breaks out and starts creating order blocks again. But what I wanted to explain was how you can read price action by the frequency and the degree that the market creates them and invalidates them. So that is everything, well, the basis for on order blocks. And I believe it is so powerful. It's so simple, but so powerful, can be so powerful for your trading. If you understand order blocks, you are miles ahead of many traders.